Investing basics. What are equities? Investors in equities, or sometimes stocks or shares, essentially buy a fraction of the company they have chosen. Companies come in all shapes and sizes, but all will have shareholders. Public companies issue millions of shares that are bought and sold on the stock exchange every day. The value of a company is calculated by multiplying the number of shares it has issued by the value of each share. Many individual shareholders may own small stakes in a company, as well as institutional investors, such as asset managers or pension funds. Public limited companies are limited liability vehicles. The most you can lose if a company fails is your entire stake.
Shareholders may qualify for discounts on the company's products or services. You may be able to vote on things like strategy and salaries at annual general meetings. Generally, your return is linked to the financial performance of that business. You may receive dividends when the company performs well, or be asked for more money if it needs to pay off debts, wishes to pursue an acquisition, or fund investment. In order to grow, a company may offer a rights issue, additional shares, often with preferential terms for existing shareholders. The price of a share may not directly reflect the financial performance of the issuing company, rather market sentiment, a result of supply and demand. A company that performs well and pays a dividend will attract buyers, increasing the market price of its stock. Companies are listed on an exchange for the first time in an initial public offering, IPO. Thereafter, transactions are made in the secondary market, where shares are bought from and sold to other investors on an exchange, usually through a stockbroker. Market makers consider the demand for a particular stock and decide on the price at which they will offer it for sale, the offer, and how much they will pay for it, the bid. The difference between the two prices is called the spread, and this is the profit margin on the transaction. The liquidity of a particular stock is a measure of the level of demand to buy and sell it during trading hours. Bigger companies tend to be more liquid with a large number of transactions a day, which also tends to result in a narrow spread. The internet has brought online trading and live prices to all, with transaction costs low, and an efficient market ensuring fair pricing for buyers and sellers alike. Over the long term, investing in equities and reinvesting dividends delivers a better return than any other asset class.